Folks, I can't believe this. I just read every single page in the Federal Reserve minute meeting notes from the end of September. That's September 25th to 26th. And there's something really shocking in here I have to bring you right away. These notes literally just became available October 17th at 2 p.m. Eastern Standard Time. I've had my hands on these for about 2 hours now. I've literally gone through and highlighted everything and chicken scratched everything. If you want a copy of this PDF, there is a free copy of this PDF in the description. Seriously, like, just click it. It'll just open up. You could read along with the stuff that I'm about to tell you. But this is scary because the Federal Reserve just gave us guidance on when they think the market is going to slow, and it's concerning me. So let's get right into what I believe. Then I'm going to give you a little bit of a summary as far as what's going on with the Fed, some of the good things they talked about, some of the bad things they talked about. But I really want to bring to you what nobody's talking about, and I can't believe nobody in the media is picking up on what is buried in here. I'm about to share it with you. Oh, by the way, I did put the link under the link to my course, so if you're not yet a member of the course, make sure to either leave a comment or email me as to why in the heck are you not a part of the course. So many people are loving it, and I'm blown away that you're not with me. And if you are with me, thank you so much for being with me, but I just recorded 3 amazing, super detailed lectures, and we've got like 230 lectures now. I just added another 30 lectures over the last, I don't know, 2 weeks. Anyway, let's get right to the bad stuff though. We'll talk about the course later, all right? You, me, we'll talk. Bad first, the Fed is starting to see consumers spend less. Even though consumer spending is through the roof, they're starting to see an increase in consumers save. Now, there are 2 rationales for this. One is people just want to save money, and the other, a little bit more dark, and unfortunately, what I believe, reading a little bit between the lines, the Fed is leaning towards believing is that people are starting to become more cautious. Overall, consumer optimism is high, but people are starting to indicate more cautiousness by increasing the amount in their savings. In addition to that, the Federal Reserve also started talking about a growing wedge in income equality. How many videos have I made now talking about the rich making more money and poorer folks making less money and this gap growing? This is 100% again in line with that disparity that I'm seeing in real estate investing. That is, if you're not already investing in real estate, you should be working super hard to do whatever you can to make sure you can get a good deal soon, because you don't want to get a good deal when rates are high, and we have no idea what's going to happen once I reveal to you the date they put in here. But I will give you some takeaways at the end of the video, because I know it sounds a little convoluted, like, wait, are you saying buy, but then you're also saying there are problems? Hold on, okay? I'm getting there. Let me get through this. If you haven't seen my video yet yesterday, make sure to watch yesterday's video, because that's a little bit of a precursor to what I'm going to talk about here, and there are also some more guidelines on things you should be thinking about doing right now. In addition to the Fed seeing people save more money, the Fed is starting to believe that there are going to become labor shortages, and this is going to dampen the growth of our economy. The lack of people capable of applying for these higher end jobs to produce higher end goods that are creating more volume in our economy. That's not good. Probably the biggest concern the Federal Reserve has right now is the international market. Emerging markets who have a lot of debt in US dollars are starting to have issues paying that debt back because the dollar is getting stronger. When the dollar gets stronger or more valuable, it becomes harder to pay that debt off. That is, if you have $1,000 of US debt and ordinarily, $2,000 of your currency would pay that $1,000 off. Well, now if it costs you $3,000 of your currency to pay that same debt off, you could be going into foreclosure here pretty soon solely because the dollar is getting stronger. So that is definitely a concern, because the last thing we want, and the Fed is seeing this, is emerging markets to have financial issues or crises or foreclosures, which could cause ripple effects through our entire global financial system. That's the last thing we want. The Fed really seems heavily concerned with what's happening in the emerging markets. The very second sentence of the minute meeting notes talk about volatility in emerging markets. They throw this out throughout the entire minute meeting notes. Emerging markets, this might be where the next bubble comes from. I don't think it's going to be real estate. I don't think it's going to be stocks. I don't think it's going to be bonds. Based on what the Fed is saying, it's outside of our control. Now, before I hit the dates the Fed started talking about, I want to hit their comments on the inverting yield curve. That is the 10-year, 2-year Treasury. I made some notes on the actual PDF. You could read them at the bottom in terms of how that actually works, what the expectations are for that. They're in red at the bottom. That's why you should really check out that link and the link to the course. But I think they gave a really half-hearted explanation as to why this inverting yield curve was happening, which the inverting inverted yield curve says that as soon as we get that inversion, we usually see a recession 18 to 24 months after that. The Fed tried explaining, well, we've been buying bonds, so that's maybe manipulated this a little bit. I think that's a half-hearted explanation, and honestly, once I give you this next piece of information, it kind of sounds like a bunch of baloney. Quick note, it's very important to know that all of this is written in past tense because the minute meeting notes are made after the meeting. Over the 2018 to 2022 period, output was projected to rise at a rate above or at staff's estimate of potential growth, and then slow to a pace below it in 2021. The unemployment rate was projected to decline further below the staff's estimate of its long-run natural rate, that's good, but to bottom out in 2020 and begin edging up in 2021. Folks, they think GDP is gonna go down in 2021, unemployment's gonna go up in 21. So that's bad. Now, they do think it's possible that household spending and business investments could expand faster than the staff is projecting, but they only extend that as far as they think tax cuts will help. On the flip side, or the downside, trade policies and foreign economic developments could move in directions that have significant negative effects on the US economic growth. They even throw up two charts that show us that decline. And folks, when the Federal Reserve starts telling us, yeah, that maybe that inverted yield curve thing saying we'll be in a recession in 2 years, don't really worry about it. But we kind of at the same time think we should raise rates between now and a couple years from now because, maybe we just don't want things to get overheated because maybe that R word will happen in 2021. Why else is the Fed saying unemployment would go up and the United States GDP would decline in 2021? Now, it's not a dramatic decline, but of course, right after they start indicating that inflection point, what do they say? Oh, that don't know anything beyond that, sorry. So the projection they're giving us is, they're telling us there's going to be a lot of volatility coming in the next 3 years. We're going to start seeing numbers get worse in the next 3 years, and we need to be really aggressive to make sure that we get rates up so we keep the economy from overheating, because if the economy continues to overheat, then we're gonna see even more damage when that inflection point happens. That's scary. And I don't understand why nobody's reading this and pointing this out. Like, share this with somebody in the media or something, because it's right there, download it. Now, here's some other things that were said, and then I'll give you some big takeaways. The Federal Reserve said that investors already expected the Fed funds rate, which kind of leads to interest rates going up in the real estate market, to go up in September, and therefore they're kind of like, yeah, let's just go ahead and push them up. A little bit reading in between the lines, you can read the actual verbiage in this. They also said that they think the same thing is going to apply to December and March, and they'll probably raise them again in the latter part of 2019. We're going to be approaching 3 to 3.5% as a Fed funds rate very, very soon here. I do not see rates going down over the next 2 years. The Fed is starting to sound very, very bearish. In addition to that, the Fed said, no longer are we going to call ourselves accommodative. In fact, most of the people on the board are starting to say we need to become restrictive to the economy because they're projecting an inflection point coming in 2021. They did continue to mention that currently GDP growth is strong, labor conditions are strong, and in terms of housing, well, they dedicated a measly 2 paragraphs to it, just saying that sales volume was starting to decline. So in other words, the Federal Reserve right now is just giving the housing market and real estate the big middle finger and saying, don't worry about your houses, we're worried about a bigger problem happening in the market right now, so hold your horses and let us raise rates and try to eliminate what's about to happen. So that was actually really eye-opening to me because we're so used to 2007, 2008 where housing was the center of everything. This might not be a housing bubble. This could be an emerging market problem. This could be a global problem rather than a real estate or stock problem. And that's what I think the Fed is reacting to. They even mentioned that subprime loans aren't an issue right now. So here are the big takeaways. The odds that the Federal Reserve is not going to raise rates at one of the next few meetings, I think just went in the toilet. In terms of real estate, and because of the income equality gap and what I was talking about in yesterday's video, I think it's extremely important that if you're not already somehow tied to assets or things that appreciate in the long run, whether it's stocks or real estate, I highly recommend getting in, but get in on a good deal, like a very good deal right now. You want to insulate yourself. You want to make sure you don't have a lot of variable rate loans. I think those are going to become very expensive here very soon. I want you to stay away from anything that would increase your monthly payment. Do a 30-year mortgage instead of a 15-year mortgage, and really try to get the numbers to line up as best possible. Look, if you have to park 25% down and you get a break even, fine, so be it, but I wouldn't be getting into major negative cash flows right now with the expectations that prices are gonna go up at some kind of large leap forward. No. Just think about parking money somewhere, take the tax benefits, pay down principal, and just let's ride this out. As I always say, get on the roller coaster and then just be a part of it. But if you're sitting on the sidelines, because we don't know exactly what's going to happen, and I really see that income disparity, that income wedge happening, and now the Fed has mentioned it, I don't know, folks. What do you think? Let me know in the comments. This is all hot off the press. Like literally, this paper was still warm when I started recording this. All right, time to edit and upload.